stop what you're doing. If you follow the global semiconductor space, you absolutely need to see what's happening under the hood of SMIC's Q1 2026 results. Welcome to this explainer. When we first ran these numbers, what we found honestly shocked us. We are looking at a literal textbook paradox playing out in the global chip market right now. Top-line revenue is doing one thing, but the bottom-line reality is telling a completely different, almost contradictory story. By the end of this explainer, you're going to know exactly whether SMIC's massive domestic gamble is a brilliant long-term play or a geopolitical trap.
Let's start with a really surprising number. In the first quarter of 2026, SMIC's revenue jumped a massive 11.5% year-over-year. We're talking $2.5 billion in a single quarter. That is a huge leap, and it signals some incredibly robust demand for their silicon.
But guys, here is the mystery. Despite that double-digit revenue leap, overall net profit only inched up a mere 0.4%. Just think about that for a second. How do you grow your sales by hundreds of millions of dollars, yet your actual profit barely even moves the needle? It creates this fascinating tug-of-war within their financials, and it reveals a ton about the underlying currents of the tech industry right now.
Today, we're going to solve this financial mystery together by walking through 5 key areas: the revenue-profit paradox, global foundry market share, the geopolitical double-edged sword, margin pressures and costs, and finally, guidance and capital expenditure.
Okay, let's jump straight into Section 1, the revenue-profit paradox.
So breaking down the operating results, the contrast is super stark. You've got that 11.5% revenue growth crashing right into a 0.4% decline in gross profit year over year. The end result is just a modest 5% bump in profit attributable to owners, landing around $197 million. Basically, the money is pouring in the front door, but it's leaking out the back before it ever hits the bottom line.
So you might be wondering, where exactly is all this record revenue coming from? Well, it's overwhelmingly domestic. Nearly 89% of their revenue is generated right inside China. This is the direct result of a massive, heavily pushed China-for-China semiconductor strategy. Local clients are aggressively prioritizing domestic suppliers to build up their own supply chain resilience.
And what's really interesting here is that smartphone chips are not the ones driving this boom. Smartphone chip share actually dropped down to 18.9% in Q1, which is the lowest level we've seen since at least 2021. But SMIC didn't even miss a beat, because domestic home appliance and automotive demand expanded rapidly to fill that exact gap.
Moving right along to Section 2, Global Foundry Market Share. To really understand what these numbers mean, we gotta zoom out. According to Counterpoint Research, SMIC just delivered a record quarter to secure the number 3 global spot with a 5% market share in the pure-play foundry space. Now, yeah, they are still light years behind TSMC's staggering 73% dominance, and they're trailing Samsung's 7%, but grabbing that number 3 spot in this hyper-competitive environment, that is a major milestone.
But the crazy part is how they achieved this. They are running their factories incredibly hot. They hit a near maxed out capacity utilization rate of 93.1%. They are literally churning out chips almost as fast as their current equipment will physically allow.
All right, Section 3, the geopolitical double-edged sword.
So, if they are running at near max capacity and growing revenue, why is the bottom line struggling so much? Well, it fundamentally comes down to geopolitics. SMIC is caught in this brutal tug-of-war. On one side, they've got the massive tailwinds of Beijing's push for domestic chip reliance, right? That guarantees them a steady, massive stream of orders. But on the other side, they're constantly battling the headwinds of U.S. export controls, which actively cut off their access to advanced Western manufacturing tech.
And the friction from this dynamic creates some very real supply chain headaches. Take China's surging electronics exports, for example. That surge is actually causing upstream input prices to spike, specifically for things like hydrogen fluoride, which is an absolutely critical component in the DUV lithography process. Because of the complex global supply chain, these disruptions create severe, cost-driven margin pressure for SMIC. They're just flat out paying more to make the same chips.
Which brings us perfectly to Section 4, margin pressures and costs. Let's look exactly at where all that record revenue is going. Operating expenses are soaring. They exploded by 42.5% quarter over quarter, jumping from roughly $179 million at the end of 2025 up to nearly $256 million in Q1. Year over year, we're looking at a 30% increase. Why are costs rising so unbelievably fast?
Well, because SMIC is forced to establish proprietary technology without access to those cutting-edge Western tools, their R&D and capital expenditure costs are just massive. They are essentially having to reinvent parts of the wheel to overcome the technology gap. And as you can imagine, that is a profoundly expensive endeavor that directly pressures their earnings.
The detailed financials really drive this home. There's a 15% year-over-year increase in the cost of sales. When your cost to make the product goes up faster than the revenue it brings in, your margins get crushed. This dynamic dragged gross margins down to 20.1% for the quarter, compared to 22.5% a year earlier. They are literally making less profit on every single dollar of revenue they bring in. Finally, Section 5, Guidance and Capital Expenditure. Despite this heavy margin squeeze, SMIC is making some massive financial bets on its future. Looking ahead to Q2 2026, their guidance is remarkably strong. They're projecting 14 to 16% sequential revenue growth, with gross margins stabilizing between 20 and 22%. Plus, they are injecting a staggering $7.8 billion into expanding their 7-nanometer process capacity. That is a huge spend to push the technological envelope.
But to fund this aggressive expansion, on top of the $1.56 billion they already spent on CapEx in Q1 alone, capital preservation is absolutely key. So, SMIC announced they will make zero profit distribution to shareholders for 2025. No cash dividends, no bonus shares. They are holding on to every penny they can to ensure they can meet this high demand and keep their core business developing.
Yet, through all of this, management remains super confident. They explicitly stated they are more optimistic about our overall business for this year compared to last quarter. They see this expanding order backlog driven by robust local demand, and they are fully gearing up to meet it regardless of the high upfront costs.
Which leaves us with the ultimate question. Will the massive tailwind of domestic orders be enough to overcome geopolitical restrictions and high capital costs to achieve true tech independence? Their top line shows they have the demand for sure, but that bottom line shows just how ridiculously difficult and expensive the path forward really is. Thanks for joining me on this explainer, and I'll catch you in the next one.